President Donald Trump is pressing the Senate to pass a significant tax and spending bill by July 4th, following its narrow approval in the House. The proposed legislation aims to extend the 2017 tax cuts and introduce new ones, including eliminating taxes on tips, while significantly increasing spending on border and national security. To balance these tax cuts, the bill proposes substantial reductions in federal spending, such as imposing work requirements on Medicaid and SNAP recipients, potentially affecting millions of Americans. The bill has ignited controversy and debate. Critics, including billionaire Elon Musk, have condemned it for favoring the wealthy through extensive tax breaks, while Senate Democrats, led by Chuck Schumer, argue it undermines essential services for low-income individuals. Some Republican senators, like Rand Paul, oppose the bill's provision to raise the debt ceiling by $4 trillion, complicating its passage. Treasury Secretary Scott Bessent has warned of a looming deadline to raise the debt ceiling to avoid a default, adding urgency to the Senate's deliberations. As negotiations continue, discussions focus on potential changes to state and local tax deductions and the impact of proposed Medicaid cuts. The Congressional Budget Office is expected to release an analysis of the bill's fiscal impacts, which will likely influence the ongoing negotiations and the final vote. The outcome of this legislative effort is critical, not only for Trump's agenda, but also for addressing the impending debt ceiling issue, with significant implications for the U.S. economy and political landscape.
Dollar General has reported record quarterly sales of $10.44 billion, surpassing Wall Street's expectations of $10.29 billion, as economic uncertainty drives consumers towards bargain retailers. This strong performance has led the company to raise its annual profit and sales outlook, contrasting with traditional retailers like Macy's, Target, and Best Buy, which are adjusting their forecasts downward amid customer anxiety and tariff impacts. Despite a slight 0.3% dip in customer traffic, Dollar General saw a 2.7% increase in the average transaction amount, contributing to a 2.4% rise in same-store sales. This shift towards more cost-effective shopping options is reflected in the company's shares, which surged over 15%, and also boosted shares of competitor Dollar Tree by 6%. The broader economic context includes a 0.2% contraction in the U.S. economy from January to March, marking the first decline in 3 years, largely due to trade tensions under President Trump's administration. While Dollar General's earnings per share of $1.78 exceeded the expected $1.47, the company remains cautious about the future impact of tariffs on its operations and customer base. The retailer has adjusted its earnings forecast for 2025 to a range of $5.20 to $5.80 per share, with anticipated sales growth of 3.7% to 4.7%. This cautious optimism is tempered by the vulnerability of lower-income consumers, who are particularly affected by financial pressures, despite an uptick in spending in anticipation of tariffs. In the broader market, Dollar General's stock movement was part of significant midday changes driven by earnings reports and strategic corporate actions. Other notable market movements included a 17% surge in Ferguson Enterprises stock and a 12% increase for Signet Jewelers following strong earnings reports, as well as a 15% rise for Sitio Royalties after a major acquisition announcement. Conversely, EchoStar's stock fell 11% due to regulatory uncertainties, while Bumble's stock dropped 6% following a downgrade. These developments underscore the dynamic nature of market responses to earnings, strategic decisions, and analyst evaluations.
The Eurozone has witnessed a significant decrease in inflation, dropping below the European Central Bank's ECB target of 2% for the first time since September of the previous year. The decline, primarily driven by a reduction in services inflation from 4% to 3.2%, marks a pivotal moment as the ECB prepares for its upcoming June meeting. This development is partly attributed to the recent global trade tensions, which have led to a decrease in commodity prices and a strengthened euro, alongside the European Commission's decision to avoid retaliatory tariffs against the U.S. These factors have collectively contributed to a muted economic environment within the Eurozone. Despite the positive inflation figures, the sustainability of this trend remains uncertain. Survey data suggests that the drop in services inflation might not be structural, hinting at a potential rebound. Furthermore, While unemployment has reached a historic low of 6.2%, wage growth has decelerated, suggesting limited upward pressure on core inflation in the medium term. This economic backdrop provides the ECB with the flexibility to potentially lower the deposit rate to 2% and consider further accommodative measures. The decision will be closely watched, as it could signal the ECB's strategic direction in supporting the Eurozone economy amidst global uncertainties.
Atlanta Federal Reserve President Raphael Bostic has indicated that the current economic uncertainty, driven largely by trade policy shifts, necessitates a patient approach to U.S. monetary policy. In light of a strong economy, Bostic suggests that the Federal Reserve has the luxury of time to assess the impact of tariffs on inflation and growth, while remaining open to the possibility of a single interest rate cut later this year. Despite the central bank's March forecasts including a potential rate cut, Bostic emphasizes a cautious stance, noting that inflation remains above the Fed's 2% target. The Federal Reserve is expected to maintain its benchmark interest rate in the 4.25% to 4.50% range in the upcoming June meeting, as it monitors the effects of the current trade policies. The Trump administration's fluctuating tariff implementations are anticipated to raise inflation and lower employment, though the extent is uncertain. Bostic notes that while the labor market remains robust, some emerging weaknesses, such as prolonged job searches, are beginning to appear. Despite these challenges, Bostic remains optimistic, citing minimal evidence of tariffs significantly impacting inflation and generally positive economic data, notwithstanding negative sentiment indicators.
Byron Allen, chairman and CEO of Allen Media Group, has initiated the sale of several television stations, engaging Moelis & Company, a reputable investment bank, to oversee the transaction. This strategic move, reported by the Los Angeles Times, is primarily aimed at reducing the company's debt burden. Allen Media Group, which has invested over $1 billion in acquiring network affiliate stations across smaller markets, is now seeking to capitalize on these assets. The decision comes in light of multiple inquiries and offers for the stations, signaling a favorable opportunity to achieve a return on investment and improve the company's financial health. The media conglomerate, known for being the largest independent television operator in the U.S., has faced financial challenges despite its expansive portfolio, which includes affiliations with major networks such as ABC, CBS, NBC, and Fox. In 2024, the company underwent layoffs across various divisions, including the Weather Channel and entertainment studios, as part of a broader strategy to enhance operational efficiency. Additionally, Allen Media Group has struggled with timely payments to network owners and recently refinanced a $100 million debt facility. The company's financial difficulties are exacerbated by the shifting advertising landscape, where traditional television faces stiff competition from digital platforms and streaming services. S&P Global Ratings maintains a cautious outlook, highlighting the necessity for the company to sustain high liquidity levels amidst its current junk bond status.
Trump's Truth Social platform is advancing its foray into the cryptocurrency market with a significant move towards launching a Bitcoin exchange-traded fund, ETF. NYSE ACA, the electronic trading arm of the New York Stock Exchange, has filed a 19B4 form to list the Truth Social Bitcoin ETF, marking a crucial step in the regulatory process. This ETF aims to provide investors with a simplified means to gain exposure to Bitcoin's price movements without directly holding the cryptocurrency. This move is part of a broader strategic partnership between Trump Media and Crypto.com, which plans to introduce a range of digital asset products, including cryptocurrency baskets and ETFs. The filing comes as the market for spot Bitcoin ETFs has surged, reaching over $130 billion in total assets since their introduction in January 2024. BlackRock's iShares Bitcoin Trust currently dominates this market, holding nearly $69 billion in assets. Trump Media's recent activities, including trademarking digital asset products and unveiling a $2.5 billion Bitcoin treasury plan, underscore its commitment to expanding its presence in the crypto space. If approved, the Truth Social Bitcoin ETF would not only enhance Trump's influence in the burgeoning crypto market, but also represent one of the most politically connected entries into the Bitcoin fund sector. This development could potentially impact market sentiment and investor strategies, particularly among those seeking diversified exposure to digital assets through traditional investment vehicles.
The Asia-Pacific markets experienced a notable upswing, led by South Korean stocks, following a tech-driven rally on Wall Street. The South Korean Kospi index surged by 2.34%, reaching its highest level since August of the previous year, as the opposition party leader Lee Jae-myung secured a presidential election victory. Lee's election promises have been well received by investors, with plans to amend commercial law to protect minority shareholders and implement aggressive fiscal stimulus measures to boost the domestic economy. This political shift is anticipated to encourage more value-creating decisions by company boards, potentially leading to a more robust stock market environment. The tech sector played a significant role in the upward momentum, with chipmaker Nvidia's shares climbing nearly 3%, boosting its market cap past Microsoft's for the first time since January. This rally also positively impacted other chip companies, such as Broadcom and Micron Technology, which saw gains of over 3% and 4% respectively. In addition to South Korea, other major Asian markets like Japan's Nikkei 225, China's CSI 300, and Australia's S&P ASX 200 also posted gains, reflecting a broadly positive sentiment across the region. The strengthening of the South Korean won against the US dollar further underscored investor confidence in the country's economic outlook post-election.
Deep-pocketed investors have shown increased interest in Seagate Technology Holdings, STX options, indicating a potentially significant market movement. Benzinga's option scanner detected 15 notable options activities, with a majority of these being call options, totaling over $1 million, compared to put options valued at approximately $101,000. This suggests a bullish sentiment among these investors, who are targeting a price range between $120 and $160 for STX. Such activity is noteworthy as it often precedes substantial market developments. Seagate Technology, a leading supplier of hard disk drives, operates in a duopoly with Western Digital. Analysts have provided mixed insights, with target prices ranging from $125 to $140 and maintaining a generally positive outlook on the stock. The surge in options activities aligns with these analysts' bullish ratings, reflecting a broader market optimism towards Seagate's performance. This heightened interest in STX options could influence market sentiment and potentially drive stock price movements in the near term.
Tesla Inc. (TSLA) shares rose over 3% following a robust sales performance in Australia for May, marking the company's best monthly sales in the region in nearly a year. The surge was primarily driven by the updated Model Y, which saw deliveries increase by 122.5% compared to the same period last year, totaling 3,580 units out of 3,897 Teslas delivered. This rebound comes after a supply-constrained slump earlier in 2025 and highlights a renewed consumer interest, as evidenced by record test drive activity. Despite the positive performance in May, Tesla's year-to-date sales in Australia are still lagging, with a 48.2% decrease overall and a 27.4% decline in Model Y sales compared to the previous year. In contrast, Tesla faces challenges in the European market, with Italy reporting a 20.32% decline in Tesla registrations year-over-year in May. This reflects broader issues of slowing electric vehicle demand and increased competition in the region. Investors are cautiously optimistic, as the recent sales boost in Australia suggests potential for regional recovery, but global performance remains inconsistent. The market is keenly observing whether the positive trend in Australia will sustain beyond the initial wave of Model Y deliveries. Tesla's stock price increase to $353.84 indicates investor confidence in the company's regional strategies, despite the uneven global outlook.
Colombier Acquisition Corp. II, CLBR shares saw a decline of 9.94% to $15.22 on Tuesday, following a strong rally the previous day. The initial surge was driven by optimism surrounding its upcoming merger with firearms retailer Grabogun, highlighted by an amended S-4 filing and a revised investor presentation. This documentation included financial data projections up to March 31, 2025, and indicated progress towards completing the SPAC transaction, with the combined entity expected to trade under the ticker symbols PU and POO on the NYSE. The pullback in Colombier's stock is attributed to typical SPAC-related volatility, as traders recalibrate after the initial excitement. The market is currently awaiting further details on shareholder approval and confirmation of the listing and deal closure timelines. The transaction has garnered increased visibility due to the involvement of notable figures like SPAC sponsor Omid Malik and Donald Trump Jr., who appeared on CNBC to discuss the deal. Despite the current dip, investor interest in the firearms sector remains high, with the market poised for further developments in the merger process.